Welcome back, ladies and gentlemen, to another edition of Through the Fire. I am your host, Ryan Wickline, and today we're joined by a very special guest. He is the CEO of the Financial Literacy Group, Mr. Ron Harris. How you doing today, Ron?
I'm very good. Very good. Nice to meet you. Nice to meet you, Ryan.
Hey, it's great having you on here, Ron.
Thank you.
I'm kind of interested in the topic you wanted to talk about, so let's dive in, shall we?
Absolutely. Sounds good.
So the number one question the audience is probably wondering right now, who is Ron Harris?
Well, that's a good question. So I am the CEO, as you said, of Financial Literacy Group, but my background is kind of unique because I went to university in Europe, in England. So that kind of gave me a different point of view about what we do here and what is going on around the world. So, I've had my own marketing company. I've never really worked for anyone. So after I went to university in England, I came back home to the United States. I started a marketing company there. I had some pretty big clients. The company grew pretty fast. And I besides traveling when I was going to school, I traveled a lot of the time when I was having a marketing company. But I continued to travel after that. And I continued to travel because I wanted to kind of see, the difference in credit, the difference in accounts, the difference in banks, and the difference people. Why some people live very well when they don't have much money. Why some people don't live well when they have money, and kind of the differences in the different countries. So, for instance, just a few years ago, you could get a payday loan here, right? And so it was kind of like loan sharks, right? They charge you an astronomical amount of interest, but you can never do that in Europe, right? Those kind of things don't happen there, right? You can get a payday loan in France, right? And so when you think about the way credit is established in the United States and what goes into the credit, what they look at, what your numbers are, and that you kind of wear a brand about your credit, and that allows you to either buy things at a higher interest rate or a lower interest rate, and you kind of fit into a certain place in society if you're a consumer, in the United States, because it's a consumer built society. And so me wanting to really look at those things and understand the differences and why they are the way they are is who I am, right? And so my goal became to help people, middle class people, working class people, homeowners, right, handle their money like people on Wall Street did, right? That's what my goal is to equalize the playing field, right? Because really and truthfully, the playing field in the United States is kind of different. This way.
Yeah. So what was probably the biggest difference between like the financial institutions in Europe compared to here in the United States?
So the financial institutions here in the United States have more power. They're able to do things here and control our economy and control the way money is spent and the way people look at money differently than the way they look at it in Europe. So, here in the United States, right? For instance, here's a great example: is the American dream, right? We all know what that is, right? We aspire as people, as consumers, to have the American dream, to have a nice house, to have a nice car, to have food, to have kids, and so on and so forth. But really and truthfully, who made up the American dream, right? Who made it up, right? Not normal people, right? Because, right, the American dream was made up by financial institutions, by the banks, by the retailers. Why? Because they want you as an individual, as a consumer, to aspire to have those things. Why? Because in order to get a house, you have to finance it. To get a car, you have to finance it. So you have to pay the banks, you have to pay the financial institutions in order to achieve the American dream. They make money on those things.
Yeah. So what led you to leave your marketing company behind and say, hey, I'm going to go into finance and be a financial educator and start my own company?
So I went through a divorce in 2006, and so after that, I owned the company, from maybe in the mid 90s, and all the way through my divorce. And after the divorce, because and me and my ex-wife didn't even hire lawyers. We kind of worked it out between ourselves because I had the business and we had things. We had a son and so on and so forth, and we definitely didn't want him to see us fighting about things. So we worked it out ourselves, and she ran the business after we downsized it, and I went out and looked at different opportunities. And so I ended up getting my insurance license in 2008. And so when I got my insurance license, I tried different things, from selling Obamacare and selling healthcare, and to selling supplementals, and final expense insurance, and Medicare insurance, and because I kind of felt my way around it. And then I met a person, a guy that I met in maybe 2015, who had been in the finance industry for, at the time, 30 years. And so he interested me. He made me think about things in a different way. And he was really an expert at the way you design life insurance. And so I debated him, and we talked about this. We did research, and that's where this solution that that I'm here to talk about today came from. Came from that benefit of talking to someone who was an old timer and in this industry.
Nice. What types of services do you provide them?
So we really only provide one solution, right? And that solution is unique in the fact that it includes life insurance, which is a life insurance agency. However, we have our own technology, and the technology is a budgeting tool. So, and it's meant to meet people wherever they are, right? Whether they have money or they don't have money, what they have, their plan, what they're planning in the future, if they're planning on buying a house, so, or whatever. So the technology or the budgeting tool is actually free to anyone who wants to use it. And it has in it, of course, the connection that the bank's apps use, which is Plaid or Plaid. And so you can connect your accounts to the technology. And so it imports all your transactions. It's AI driven, it's mathematical, it's algorithm driven. And so the technology puts you in control of your cash flow, right? Now you get to see your cash flow in many different ways you never saw it before. So you understand what your net worth is, what things, what you need to do to improve your cash flow, how you improve your situation, how you, look at your money and how you make your money work for you. And that's what the solution is meant to do. Then the technology itself also has strategies, and it's 3 strategies, and these strategies are for paying off your debt early. Okay, and so the first strategy would be the size of the debt strategy, right? And the second strategy would be an interest-based strategy, so based on what interest you have on your debt. The third strategy is a life insurance strategy. Okay, so life insurance strategy allows you to become your own bank. It's different from infinite banking or banking yourself or family banking. It goes well beyond those kind of things, right? So it is the life insurance that we offer is more like the bank's life insurance, or more like rich life insurance, or more like corporation life insurance, similar to a BOLI policy. So what happened was, in 2021, at the end of 2021, the Consolidated Appropriations Act was passed by Congress. Okay? And before that, the life insurance, the way it was structured, they were still using the life insurance interest and the structures from 1984, right? And so it got updated in 2021. So what happened because of that change is now middle class people could put more money in a life insurance policy than they've ever been able to before without paying higher premium payments. So what happened is we were able to use life insurance as a tool for the technology. So the life insurance, you're not borrowing, it's an asset. So it's not built on your death benefit like normal life insurance is created. This life insurance is created based on the MEC, which is the modified endowment contract. So how much money you can pass through life insurance and still get all the benefits of it being a life insurance policy. So we're using what happened in the Consolidated Act of 2021. And so now your debt itself, right? The money that your mortgage is, the money that's going to your liabilities, right? That becomes your collateral. So now you're not borrowing against death benefit like in infinite banking. You're borrowing against the money that you're putting in it that was going to go to pay off your debt anyway. Right? So the technology shows you how fast you can be debt free. It shows you how much interest you can save if you follow the technology. And now we're able to create the life insurance based on the numbers that come from technology. Right? So again, the life insurance is a properly structured IUL, and it's we created it as an investment first, and then we changed it over to meet all the specifications, all the rules, all the regulations of a life insurance policy. But for the 7-pay test, the corridor, all those things are met, and we're staying under the MEC, so that money that goes to life insurance is not taxed. Right? So they don't have to pay the money back. They're borrowing external money, and the money still indexes, right? Even though they're using it to pay the debt down. What's really cool about this solution is that after you pay off your debt, so a 30-year mortgage you pay off in 8 years. Now you have that mortgage paid off. Now you're tax free, right? You borrow to get your own life insurance policy. You have no recourse because you're the bank, and so now you can use life insurance after you pay off that debt to put all the money that was going to the debt and your discretionary income into the life insurance policy and earn interest on that money too. Okay?
Huh.
And then after you started getting Social Security, you take Social Security payments, put them to the life insurance, and borrow that money out and spend that money. So you have access to money. You're not waiting for your death benefit. Your 401k, your IRA, your mutual funds, your annuities, whatever nest eggs you have, you take withdrawals from those, right? And you're going to get taxed by the government at your tax rate, whatever tax rate you're at. But you can put that money in life insurance, borrow the money out of life insurance, and still spend it. Now you're earning money on that. What's beautiful about the life insurance is you're earning interest on the accumulated cash value of life insurance. So the more money you put in, the more debt you have, the bigger the amount of money in your life insurance that's earning interest. That's indexing.
What is hybrid financial arbitrage?
So hybrid means that, of course, that we're doing something kind of outside of the normal. Okay, financial, we're in the financial industry. So arbitrage is this. So what I was just explaining to you on how the banks operate, and banks use life insurance, because they do, right? Banks, even though they tell people they don't use life insurance, they don't tell people that life insurance is protection and for legacy. Banks are using life insurance. So if you're using life insurance in the normal way, or you're dealing with banks in the normal way, the banks make money because they make money on the spread. So they might get the money that you're depositing, and they pay you the interest rate that they promise you on the deposit, or they borrow money from the prime at the prime interest rate, and then they mark that money up and they loan it to us. The bank then makes the spread, the difference between what the money costs them and what they're lending it for. They make that money. In this situation, the arbitrage, that is the arbitrage, right? The delta between the money that they're making. So in this case, with our solution, the client doesn't pay the bank that arbitrage. They were getting an arbitrage because they become their own bank. Right? So hybrid financial arbitrage is because this is outside of the normal, right, thing that banks do, the way the banks operate, and financial because it is a financial instrument, and arbitrage because now the client is earning that spread, the arbitrage. The client themselves is getting that money.
Nice.
Yeah.
Why have most Americans never heard of this strategy?
That's a great question. So the strategy, of course, as I said, it's pretty new in comparison to other things that are out there, because in 2021, right, before 2021, it was kind of an obscure. It was only the banks using that. But so the reason people haven't heard about it is because there's no real training besides us for anybody to use this kind of solution. So advisors, planners, right? They're trained by, if they work for Merrill Lynch, they're getting trained by Merrill Lynch to sell Merrill Lynch products. If they work for Raymond James, they're getting trained by Raymond James to sell Raymond James products. And advisors normally get paid by fees, and the fees are on the amount of money they have under management. So if you have your mutual fund, your 401k, your IRA, right, all those kind of tools, your investments in the stock market, is how insurance, or is how advisors get paid, right? So in this case, right, the money is not really staying in those kind of vehicles. The money is in life insurance. So there would be less money to be managed by an advisor. And for other life insurance agents who have been out there and in the market for a long time, if they have a big book of business and they're selling life insurance, right, or they're selling life insurance in the way they have been in the past, let's say, and so the life insurance that they're creating is normally created based on the death benefit. The client says, I want to have $500,000 or whatever, dollars in death benefit. So in that case, the insurance agent will create the life insurance to meet the client's needs and meet the death benefit. And they're not thinking about or getting trained the way we get trained, where using life insurance becomes an asset. So the death benefit, in the way that we do this, is kind of on top of everything else, right? The actual purpose of this life insurance that we are creating is for people to take advantage of having access to the money today, right? You can't have access to the 401k, right? You have to wait till you're 59 and a half. You can't have access until out of retirement vehicles, because that money is set for retirement. With life insurance, you can access the money now. So insurance agents who have been in the market for a long time, they haven't been trained on how to offer this, and they're probably not going to want to get trained or spend a lot of time getting trained on this, because they can sell a life insurance policy the way they are and get it paid in advance, because that's what you get paid normally in advance, and then the client will never see them again. So there is not that they're dishonest, not that advisors are dishonest. Many times they've never been trained on this kind of, or to offer this kind of a solution, right? And they don't know that it exists because it is pretty new. But when you look at it, when you think about it, the goal of hybrid financial arbitrage is to move people to the tax-free box, move more of their money to the tax-free box. They have a tax box, they have a tax-deferred box, 401ks and IRAs are tax-deferred, but then you have a tax-free box. And so in life insurance, when you borrow money out of life insurance, it's tax-free. Right? So you don't have to pay any taxes on that money, right? The death benefit is tax-free. There is no death benefit in a 401k or an IRA, right? They're limited in how much money you can take out of them or how much money you can put in them, right? With life insurance, I can create the life insurance pretty much any size the client wants.
Nice. What made you to decide to write a book on this subject?
So I have made attempts at kind of just trying to describe this, for the last, since 2020, right? 2020, 2021, when I first started really digging into this. And so I've written 5 books already, and most of those 5 books that were published already, I did self-publishing. This last book, the 6th book, that is kind of the subject here, which is really talking about everything that has to do, right, and comparing hybrid financial arbitrage to everything that's out there. What the paradox is. How does it compare to a 401k? How does it compare to an IRA? How does it compare to a TSP? How does POLI is what life insurance we call it POLI, because is similar to BOLI, which is the bank life insurance. And so, how is that different from a normal whole life policy? How is it different from a normal IUL policy? How does it differ from infinite banking, the solution? How does it differ from be your own bank or banking yourself? And so all of those things, right, is kind of what we compare in the book. And I'm talking about the myths that are being dispelled, because one of the biggest things that I hear from people, when I'm talking about the solution or going into the solution, is it's too good. It sounds too good to be true, right? And or that's what people think. So if it's outside of the realm of what the banks have been telling them, right, then they're skeptical about it. And in this case, skepticism can be good, but skepticism about a solution that, for instance, this solution, which is built around life insurance, has been in existence for a century. The banks have been using it for 100 years. It is not something wild or a loophole. This is written into law.
Huh. What would you tell someone like in our audience listening right now with that same very point? Hey, this sounds too good to be true. What would you say to them right now?
I would say to them, okay, so yes, it may sound too good to be true, but you need to do your research, right? You need to look at what this is really doing. And when I send my letters, the first meeting that I have with someone, I normally educate them. I show them how the technology works with the data about that, and then I show them what the banks are doing and how the banks are doing this. So when I show a person, right, about this solution and how it works, what I do is I show them the banks. So there are over 3,000 banks in the country, right? There's a lot of banks, 3,000. And the banks use life insurance. So the top 15 of these 3,000 banks, Bank of America, Chase, PNC, Wells Fargo, all those kind of banks, they have. So Bank of America has $24 billion in this kind of life insurance. So why is it that the banks are using this and doing this and using life insurance the way this works, and normal people are not? The only difference was what happened in the appropriation in the Consolidated Appropriation Act. So if it's not too good for the banks, why is it? Why is it not too good for anyone?
Yeah.
Right.
Yeah.
So I can show them a list of the banks, which is what I do all the time, right? I show them the banks and how they're using it and what they're using it for, right? And the corporations do it too. Some people don't know that Wells Fargo is one of the largest. No, not Wells Fargo. Sorry, Walmart. Walmart is one of the largest owners of life insurance in the country.
Huh.
People don't know that. People don't realize it, right? So.
Well, yeah, and of course they're not going to divulge their secrets of what they're doing too.
No. But the secret is that they've been hiding this kind of life insurance. Right? They've been using it but hiding it. So, and for the banks, it's even better, right? So think about this: the banks make money on everyone. That's why they're in any economy, the bank is doing well. The bank make money on the rich. They get involved in their endeavors, right? They support them. They give them advice. They loan them money, right? And they help them with their investments. They make money on the middle class and the poor because they charge them fees. They charge them interest, right? So when a bank is getting this kind of life insurance policy, is kind of different. It's called BOLI, and the banks have overhead. Think about that. The banks have buildings, and employees, and wages, and all kinds of benefits that they have to pay, and so the banks also have capital reserve. So the banks have to keep a percentage of the money that we put in the bank. We put it in checking, savings, or whatever. They might loan their money out to other people, but they have to keep a percentage of the money in the bank. So amortization, when you think about it, is really a trick, right? It's the way the banks finance a mortgage, but the banks are getting their money up front, right? They're getting taxes up front. So you're paying, that's why you pay 30 years for the house. It's because you're paying the bank first, right? And they're getting interest. The second trick that the banks use is balance sheet. Okay, so the banks have a balance sheet and the corporations have a balance sheet, right? Rich have a balance sheet. Normal people don't have a balance sheet. They don't have kind of asset that banks use. So when it comes to capital reserve, the banks use three major assets, and these assets are on the bank's balance sheet, not cash, assets. And the first asset is mortgages, safest loan, most profitable loan, heavily collateralized. You cannot get away from the bank. You miss a payment, the bank will chase you for it. Second is recourse loans. And recourse loans are installment loans, credit cards, furniture loans, student loans, right? All those kind of loans, they're amortized and they're in this category as well. The third thing that banks use for capital reserve, believe it or not, is life insurance. It's on the bank's balance sheet as an asset. So middle class people don't get that kind of asset on their balance sheet. They don't get a balance sheet, right? So the banks, as I was saying, that they make money in any kind of economy. So the banks make money on the poor because they try to beat an interest. So think about it. They take the fees, they take the interest, they take the deposits that middle class people are, paying them, right? And the bank then takes that money and they overfund the life insurance policy with that money. Okay? And so now the bank is using our money to overfund the life insurance. And then the bank can borrow from the life insurance. And the money that they borrow is the money that they put in. So the money that they cash back is our money, is their collateral. The bank can then borrow against that money. And because they're borrowing against that money from life insurance, they don't have to pay the money back. And that money is still, even though the bank is using it for benefits and wages and whatever they're using it for, that money is still earning interest. It's still indexing, right? And there's no federal tax on the money. And best of all is that life insurance or that policy or that money has a 0% floor, which means that the bank cannot lose any of their capital. So, right? So the banks can borrow from the money, can overfund the policy. They can borrow from the policy. They can earn interest from the policy. They can use the money today. They can use it for any kind of benefits or assets, right? And that life insurance becomes an asset. And on top of all that, even so, the bank has to insure interest on key people, management, executives, and so on and so forth. They have insure interest on those people. So the bank, the benefit, the death benefit, if that person passes away, it's just a icing on the cake for the bank because they got to use that policy for all those years that they have owned the policy.
Yeah. What does a typical family look like before and after implementing HFA?
So the difference is that people who are implementing HFA are probably more astute about their money. They understand where their money is going. They understand what's leaking out of their budget, right? Because they're using the technology and now they can see things in a different way. So they're much smarter, much more educated about money. In our tool, not only do we have like financial literacy courses so that people can take those and learn about their money and those kind of things, but they can see, they can apply it right directly to the budgeting tool right away. So now they are smarter about their money. And so when they buy life insurance and when they get life insurance, right, they get life insurance because it's a logical thing to do, not because somebody is selling them life insurance. So they're more astute. They're a better life insurance client. They have a different reason to use life insurance than the normal person who's going to get life insurance. So they become more astute, right? They're more smart about their money. They make better decisions. They lean on the technology because you can ask any question. You can say, hey, I'm in a store. You can bring it up on your phone. I'm in a store. I'm thinking about buying a TV. It's $25. How does that affect my budget? To tell some. And so they're smarter. And now they realize that, and they can watch the money grow in their life insurance, right? So think about it. If I have someone who's in there and I make their net $100,000, so they can means that they can put $100,000 in the policy every year, and they can borrow $100,000 out of the policy, right? and they can still use the money, right? So if they do that for 10 years, right, they stuff it, they put extra money in, they savings account, whatever they get, they put in life insurance, and then they borrow out. So now they have $1 million in the cash value of the life insurance, and that money is indexing. So these people are happier because they're not using tools that that have sometimes are not meant really for retirement. 401k, when it was first introduced, wasn't meant for middle class people to use for retirement. It was meant for the rich to use, right? And it was replacing the pension, where at that time you realized that when it was a pension and the company paid people for their retirement after they worked, that they retired there, and they continued to pay them, the company was making all the decisions about losses and what the stock market and what to invest in and so on and so forth. Now with the 401k, it is switched to the actual employee. They're now making those decisions. And so, right, if they're using if they're using HFA, then they're normally more secure, right? Then and I don't knock 401ks or IRAs or anything, because those things are useful. They want to do it, especially if the company is matching someone with a 401k, right? The company's giving you free money, you want to take it. But if your company matches 6% in the 401k and you're putting in 8% of your income, the 2%, right, you shouldn't put it in. You should put it in something else, right? You should match up to what the company is matching for you, 6%, put in 6%, and then take the other money and put it in something that's going to benefit you yourself directly. That, right? Because 401ks have limits. 401ks also have R&Ds. So when you turn 73, right, you're forced to take out money from your 401k, whether you need it or not, and you have to pay tax on the money based on your taxes. So to answer your question, somebody who's using this technology, they started using the time in the correct manner, and it's not. I'm not saying that this is easy, right? There's discipline. There's things that you have to do. Paying off your debt is no easy task, right? And going through the phases, and there are 5 phases of this solution, but you get to see how you reap your benefits from the technology. So you become a wiser person about your money, and you're a smarter person about your money, and you're a better. You retire better because you retire with more tax-free money.
Yeah. So you hit on 401ks. Should people just stop contributing to them altogether?
No, they should still contribute to them, right? Because those are, and they in many cases they can't stop, right? The states, when the state if a state is creating a retirement program, in most cases the state is creating a retirement program with a 401k in it, right? So no, people should never stop, contributing to a 401k or their nest eggs that they have currently at their jobs, especially if the company is matching them. So no, you shouldn't, right? And then you can't take the money out of them early, right? Before 59.5, because you get a penalty, 10% penalty if you do those things. You can't really even roll over your 401k into a life insurance. You can roll it over into other things if you want to do that, or you can withdraw. So you know that in a 401k, the money that you withdraw from your 401k, you have a percentage that you shouldn't go above. It should be around 4% that you should take out of your 401k. And every time you take money out of your 401k, right, it reduces the amount that's in your 401k that's invested. If you happen to have a 401k and the market happens to have a correction, because the market corrects every 4 to 5 years, right, then you're going to have a difficult time during your retirement. So if you have time to recuperate with your 401k, then the 401k is not bad. You're still, even when you're investing money in a Roth, or you're rolling over money into a Roth or an annuity or whatever, you still want to leave some money at risk, right? You still want to be partially in the market to have, right? Even though you're subject to what the market does, you still want to leave some money in the market. The life insurance, again, has a 0% floor, and just you understand that and it has a cap as well, and the cap right now, is about 11%. So you can't make more than 11%, even if the S&P goes up higher than that. However, for the last 20 years, index money has outperformed the market because it gets under the losses.
Nice. How does HFA actually pay off a 30-year mortgage in 5 to 7 years without changing the budget?
So, great question. So what happens is the client is just redirecting the money that they're using. So when you talk to an advisor, you talk to to a normal insurance agent, these agents, they treat debt as a separate subject. So investment is one subject, right? And then debt is another subject, right? And so what HFA does is we make those two things, they're one subject. It's two sides of the same ledger. So think about it. If you're investing money and you're doing well and you're making 7%, but you have a mortgage and you have loans and you have $500,000 worth of debt and your interest rates, the average is 20%. You're not making money, right? You're making money that you're earning from your investment that's going to your debt, right? So the debt slows you down, right? The debt slows you down. And so what the technology does is it helps you look at how much money is leaking out of your budget, whether it's money that you're going to Starbucks and paying, right? Or you're spending money here, money's leaking out of your budget. The banks, the financial institutions know this. Like they know that you're spending more money, and they have an average of they're going to make between $1,000 and $3,000 a year on you just overspending, right? But then if you're financing, right? For instance, you're financing a house or you're financing a loan, right? The bank is expecting anywhere from $200,000 to $600,000 per family over a lifetime. So think about that. Think about it. If there's 100 million families and they're all doing this, right? That's a lot of money. So the way the technology, what it does is it's monitoring your cash flow. It's watching how you pay your bills, when you pay your bills, how much your bills are. And it's looking for your discretionary income, the money you are not using. So, and that increases the smarter you get and the more you pay toward the principal of a debt. So what you're doing is you're paying toward the principal. So your deal with the mortgage company is to make a mortgage payment every month, right? So that's what your deal is. So what you're doing in between the payments is up to you. If you target the principal of the debt in between the payments, you reduce the amount of interest that's going to those. Okay? You pay a principal payment, there's no interest on that payment. Because you paid the principal already. You already paid the mortgage payment that month, and now you paid 5 principal payments. Now you saved all that money for the interest on those payments. You still have to make a next payment the next month, but now your mortgage is 5 months shorter, right? So if you starting out and you make 5 principal payments in the second, third, fourth, and fifth, and sixth month, or for those months, right? And now what happens is you make a big sum of interest because you now pay those principal payments. So the bank, what that does is they move those payments to the end of the mortgage, even though they might be in the beginning because the payments are very high in the beginning. The interest payments are more high, and so they move those payments. They move that principal that you paid off to the end of the mortgage. So instead of having 359 payments left, you only have 352 payments left because you paid the principal on those payments already. So if you keep doing that, the technology, what it's doing is it's monitoring your cash flow. So it doesn't want you to make minimal payment, and it doesn't want you to try to guess or try to make payments and pay off your debt. It wants you to follow it because it is looking at your debt. And it's using timing, and it's using the principal payments, and it's using exactly how you can use the money that you have left over after you pay your bills already to redirect it to pay the principal of the debt faster. Right? So it's capturing in the principal and it's using your discretionary income. So it doesn't change your budget. It's the money you already have. You're just redirecting the money. And it's the money that you're going to pay to the mortgage anyway. The money you're going to pay the debt anyway that you're using. and now you're redirecting it to the principal of the debt early, therefore eliminating the interest. And so now you can pay a house off in a short period of time.
Nice. What would you tell someone that thinks this is a sales pitch for life insurance?
Well, again, research. Do your research, right? That is important to do your research, right? And so this is not a sales pitch for life insurance, because when I'm offering this technology, we don't diagnose anybody's case, right? The goal of the solution is to solve somebody's problem, solve the problem. So if the problem is debt, the problem is they're going to pay paycheck to paycheck, or the problem is money is leaking out of their budget or whatever. We're looking to solve those problems, right? So we're not looking to sell life insurance. We're not looking to sell anything. Our goal, really and truthfully, with the solution is to change their mindset, right? It's to make them stop thinking so much like consumers and to start thinking more like banks, right? So I don't bring up life insurance. I show it. I explain to them what they do with it, and we never try to close on life insurance. What we do is we show people how to use technology, how to become smarter about their money, and they make the choice to use life insurance. They can use savings account, right? And they can use a checking account. They can pay the debt off faster, right? But if you're using those savings account, checking account, or even a HELOC, right? You're withdrawing the money from those. So that money is now gone. Once you've withdrawn it and used it, it's gone. But in life insurance, you get to borrow that money out. So here's a choice. Do you want to pay off your debt and make money on the money? Or you want to pay off your debt and just be debt free?
Yeah. What is one thing you want every working family in America to know?
So that they can do this too. Things have changed. We've all been brainwashed, right? We all have, been listening to the banks. They advertise to us. They have big budgets. They know how to get to us. They know how to make us feel like we're being outside outside of the normal, right? And this solution is outside of the normal, right? And there's lots of things, lots of myths, what I tried to dispel in the book. However, right, a middle class person can do the same thing as the rich have been doing. There's nothing outside of what they've been looking at before, except the things happened in the Consolidated Appropriations Act of 2021, that allowing people to use life insurance in a different way as an asset, so they can put their money in life insurance and not concerned about the death of it. They have access to the money. That is huge when you have access to your money.
Yeah.
So middle class people can do the same thing. Absolutely.
Yeah. How can people get a hold of you?
So they can definitely go to our website, which is financialliteracy.group. They can go to the website and they can contact me there, or they can call, of course, and they can. My phone number is area code 213-419-1600. It's a direct line. They can dial any extension, because we train the agents so that they become what we call FLGPEs, Financial Literacy Group Professional Educators. So any agent that's in our agency can help you and build this and tell you exactly, using your numbers. That's the most important thing. There's nothing here is about emotions or what crossroad. The numbers do talking. We look at the numbers. The numbers tell us. So we can even look at the numbers for future things that you want to do, right? So you want to. You have a kid that's going to college. You're going to do a wedding. You're going to buy another house or whatever. We can put those things into the technology and see what the technology tells us, what the numbers are, right? So now you're not guessing. You're looking at things based on the numbers. And so, right, and that's another thing. Middle class people, working class people, what they're missing is a couple of things that I've been talking about here. First of all, realizing that debt and investments are the same, two sides of the same coin, right? They can use those kind of things, but also that that the way life insurance being used as an asset and using life insurance in the same way is big for them. They're currently playing the game on the bank's financial field, by the bank's rules. The banks have brainwashed us all. So when you talk to your cousin, you talk to your friends, you talk to your parent, your sister, or whatever, and they're going to kind of say the same thing because we've all heard it. The life insurance companies, right, or the banks have us brainwashed. They're making us think a certain way. So once you break that mold and you start thinking your own way, you free your mind and you realize that there are things you can do, it's a big difference.
Yeah. Is there anything we haven't covered that you want to talk about?
So another thing, I think one more thing I think I want to talk about is about the resources. So another thing that middle class people, working class people don't have that the corporations do, the banks do, the rich do is tools and resources, right? We don't get those same tools, right? We don't get the advice that the big banks and companies who have big balance sheets and have lots of money do. They get advice, and so as a middle class person, you're kind of on your own, right? You have to look for those right tools and the right resources that you can use that will put you in the game, so you can change the way you think about money and the way you think about your finances, right? And that's what's really important, I think. And so that was something that I wanted to make sure that, again, having the right tools, having the right resources, right, put you in a different position, right? It makes you look at things differently.
Yeah. All right. Final question.
Sure.
What is one piece of advice you'd like to leave our listeners with about overcoming adversity?
So don't be discouraged or skeptical about everything you hear. Do your own research, right? Read the small print, right? Don't listen to just what the banks tell you that you have to do. Those things are not always correct, not always in your best interest. So it's funny, when I first started this, right, and I joined an association, and because they were having to call for speakers, okay, and they were having the people in the association vote who was going to speak at the event. And so I ended up getting a lot of votes because I put this solution in. I was kind of new at it, but I still could, describe it, and people were very interested in it. But then I didn't get picked by the association to speak, and I kind of wondered why. And I realized because the media, the conference itself, was being controlled by the financial institutions. They're putting the money up. They're paying for this. So when you think about things and you think about advertising you see on television, and you see the banks advertising and telling you that they're giving you this discount for this, or they're giving you a gift for that, or they're doing those, you have to look past those things. Instead of thinking about how much that does that cost, you have to think about how does that affect my future. That's what you need to do to overcome the adversity.
Great advice. Ron, I can't thank you enough for coming on here and sharing your insight and knowledge with us.
Yeah, thank you. Thank you for inviting me. Yes.
Not a problem. Well, guys, that's going to be all the time we have here today. Remember, the only way to get what you want is to go through the fire.